Hello and welcome back to the House of Trade, where we talk to you about the murky world of financial markets and how to get you into a consistently profitable trader. Today, I want to dive into an intriguing topic that's been making the waves over the last few decades. And what is that? Well, it's the real estate sector in China and its impact on the country's growth. It's been quite a journey and I'm excited to share it with you all. So, picture this. For years, China's growth engine has been none other than its booming real estate sector. I mean, we're talking about mind-blowing growth here, demanding resources like cement, iron, copper, steel, and all sorts of components at an incredible pace. This has sparked a whole supply chain frenzy in and out of China. I'm talking about copper markets, nickel markets, steel markets, lumber markets. But the real kicker? This real estate frenzy wasn't just a coincidence. It was fueled by middle and upper middle class Chinese investors on the hunt for secure and lucrative investments for their hard-earned cash. They knew that the government had their backs, always ready to back construction companies with funding and, most importantly, low interest rates. Plus, the government was all about encouraging the shift from rural to urban areas across the great nation. Fast forward to recent years, as things have taken a bit of a twist. We've seen big players like Rice on real estate, Modern Land and Fantasia go belly up, with real estate giant Evergrande narrowly escaping a similar fate after defaulting on its international debt. This real estate crisis had everyone's alarm bells ringing, questioning the sustainability of China's incredible growth model and growth momentum. Now, what you might not know is that there's another side to this story, one that's been unfolding quietly but with significant implications for the Chinese Communist Party, the CCP. I'm talking about the rise of the Chinese stock markets as an alternative investment hotspot for those amazing savings we were talking about earlier. So hold on to your seats, because alongside the real estate turmoil, a bunch of Chinese tech companies faced a cold shoulder from the United States Securities and Exchange Commission, also known as the SEC. They couldn't make their way onto the US stock exchanges due to transparency concerns and escalating tensions between China and the US. Yeah, it's a whole diplomatic saga. And guess what? The Chinese government wasn't too thrilled about the idea that their major tech companies were being subjected to United States laws and their audits. President Xi Jinping's dream scenario, having these tech giants listed on their homegrown stock markets under Chinese jurisdiction, given their strategic significance. And who can blame him? If they were to float on these international markets, they would be at the whim of corporate espionage from United States government and also other tech rivals. To make this happen, China had to supercharge its stock exchanges in Beijing, Shanghai, both the regular one and the star market, and even in Hong Kong. This move restricted big Chinese companies to local exchanges and opened up the floodgates for everyday Chinese citizens to shift from real estate into the capital and stock markets. They were drawn by the allure of these tech powerhouses, and suddenly the money that was once flowing into real estate started pouring into the capital market instead. And what happened next is all too predictable. Now, this poses a whole new set of challenges for Xi Jinping and the CCP. With a massive chunk of the population invested in their own domestic stock markets, outsiders like us can gauge changes in public sentiment towards the government's policies and economic performance like never before. It's like a window into the relationship between the government, the party, and the people, because fluidity and liquidity in stock markets is much easier to see than the opaque world of property. But here's the twist. The stock market can also be a double-edged sword for Xi. The government's moves and announcement can send shockwaves through these listed companies, impacting their market value, their sentiment, and most importantly, how people see them from outside of China. And guess what that reflects? Yes, you got it. Public confidence or lack thereof in the government's actions. And let's be entirely real, a government like China isn't exactly thrilled about having its confidence issues aired out in the open. And that's not really that fair, because most countries don't want to see themselves painted in that picture abroad and domestically. A functioning stock market doesn't exactly align with a centralized single party and communist regime's wish list, but it has to be a necessary evil for the liberalization of Chinese markets. But here's another kicker. Xi might not have done this with much of a choice at hand. These tech companies need to find a place to list if they want to stay relevant, and the US was a dicey option. On the flip side, the real estate mess created a pressing need for a fresh destination for Chinese savings to avoid an economic slump. So, all in all, measuring public reactions through the financial markets isn't a walk in the park, but it's a big leap forward from the days of relying solely on public opinion polls. China's stock market surge has thrown open another window into the complex dance between the government, the party, and the people. And there you have it, traders. The fascinating tale of how the Chinese real estate rollercoaster led to a stock market showdown with implications that reach deep into the heart of the CCP. Don't forget to hit the like button and subscribe for more mind-bending insights. Until next time, stay curious at the House of Trade.